The retail data in March began a cliff-like decline. Are consumers completely unable to sustain it? Bank stocks kicked off the season of earnings reports, and as a result, they rose sharply today. Next, we will focus on analyzing why those big American banks were able to rise against the trend. Let's start today's video. The market opened slightly higher today, but later fell and turned into a decline. In the end, there was some unusual stability in the afternoon, but ultimately all three major stock indices closed lower. The Dow Jones Index fell by 0.42%, while the Nasdaq fell by 0.35%. As for sectors, four of them rose today while the rest fell. The financial sector rose by more than 1%, while the real estate and utility sectors fell by more than 1%. First, let's take a look at the retail data. We analyzed Bank of America's report and found that consumers are really struggling. So, is the retail data also showing the same trend? Let's take a look together. The data shows that U.S. consumer spending in March was $691.7 billion, a decrease of 1% compared to the previous month, with a larger decline than the adjusted 0.2% drop from the previous month. However, compared to the same period last year, consumer spending still increased by 2.9%. We all know that the CPI inflation data for March was 5%. If consumers bought the same things, the amount spent should have increased by 5%, but the year-over-year growth was only 2.9%, indicating that consumers actually bought fewer goods. Looking at the changes in actual retail sales over a period of time may give us a more intuitive understanding of the changes in retail data. To this end, I have created a chart showing the year-over-year growth of retail data, in blue, the CPI inflation rate, in red, and the difference between them, in gray. We can see that before March, retail data was basically in line with inflation, but it sharply declined in March. This indicates that even though inflation has been pushing prices higher, consumers were still able to afford to buy what they needed before March, so retail spending remained roughly in line with inflation. However, after March, consumers could no longer afford to maintain their spending levels and started to cut back on spending. I think this trend of cutting back on spending will likely continue. On the one hand, while inflation is slowing down, prices are still rising, and the cost of living will continue to increase over time. Consumers will have to further reduce their spending. On the other hand, people's income is also declining, as Bank of America's report showed yesterday that Americans' income is decreasing, and last week's employment data showed that the labor market is cooling down. These factors will put increasing pressure on consumers in the future, so retail data will likely continue to decline. If we look at the detailed data, it is not surprising that almost all categories of retail spending declined. As investors, it is important to pay attention to which categories are hit the hardest during the earnings season, as companies in these industries are likely to have poor performance, and we should avoid investing in them. Based on the magnitude of the decline, if we exclude gas stations, the hardest hit in this downturn is still department stores, which fell 3% month-on-month. This represents companies such as Macy's and Nordstrom. Next up are furniture, building materials, and garden supplies, which fell 2.1% month-on-month. This represents companies such as Home Depot. Electronic products and home appliances also fell 2.1% month-on-month, representing companies such as Best Buy. Of course, the companies I have listed here are only because they are indeed the most prominent names in their respective industries, and their future stock prices are not necessarily guaranteed to decline. Their leadership positions in the industry usually mean that they are more defensive in the background of an economic downturn. However, this is just a warning for us investors. If you hold stocks in these industries, you should pay attention to risk control, as their performance is likely to be lower than expected in a recession. Overall, this retail data actually exacerbates my concerns. Last week, we already saw a cooling labor market, and this week consumers are also becoming more weak. In addition to other data, the cracks in the economy have become increasingly evident. And we know that the impact of interest rate hikes has not been fully released, and the damage caused by later rate hikes will be more severe. However, the Fed's overall stance is still relatively hardline. On the CME, the probability of a 25 basis point rate hike at the next meeting has already exceeded 80%. This means that the Fed will continue to hike interest rates. But in an economy that already has cracks, further interest rate hikes will undoubtedly be a double blow. In my opinion, this is a typical manifestation of the Fed's lag, which to a large extent will make the already expected recession even more severe. Next, let's talk about today's heavy news. The bank's financial report is the focus of our observation today, but I believe that our special focus is also different. We cannot only pay attention to the performance of large banks. After all, they are one of the beneficiaries in this banking crisis. Therefore, it is very likely that the impact on their performance is not so significant. What is more important is their guidance, and how the banking crisis affects their assessment of the future credit environment. So, let's get started. Let's start by taking a look at the largest bank by size, JP Morgan Chase. In the first quarter, JP Morgan's revenue was $39.34 billion, up 25% year-over-year, which is higher than the expected $36.19 billion. Earnings per share were $4.32, which significantly beat expectations of $3.41. Net profit was $12.62 billion, up 52% year-over-year. CEO Jamie Dimon stated in the financial report that the U.S. economy is still healthy, and consumers are continuing to spend. Our balance sheet remains strong, and businesses are in good shape. However, there are still dark clouds hovering in the sky, and the banking crisis is exacerbating the risk. Although the entire banking industry is different from 2008, with fewer players and fewer problems, the financial environment is likely to become more restrictive. Borrowers will become more conservative, and we are not sure whether this will slow down consumer spending. We are also preparing for the possibility of higher and longer-lasting inflation. After reading the report, it seems that Dimon is quite optimistic, even though he is unsure whether this will slow down consumer spending. The retail data above has already shown us that consumers are slowing down. Dimon's competitor, Bank of America, also says the same thing. We don't know if it's the impact of the economic downturn, and it hasn't yet affected JP Morgan. Regarding deposits, the data shows that JP Morgan did benefit from this bank liquidity crisis. Deposits increased by 2% compared to the previous period, reaching $2.38 trillion, slightly higher than the analytical expectation of $2.31 trillion, but still down 7% from the same period last year. The CFO stated that the deposits before were both inflows and outflows, but this situation reversed after the events in March. At the end of the quarter, we should have achieved a net deposit inflow of $50 billion. In other words, the bank crisis increased JP Morgan's deposits by $50 billion. Without this help, deposits would have fallen by 10% compared to the previous year. Another interesting phenomenon is that ordinary consumers are slower to respond to higher interest rates. There has been a lot of discussion lately about the spread between money market funds and bank deposits. This financial report reveals that the response of ordinary people has been slower than that of companies and wealthy individuals. For the company's consumer and personal banking business, the average deposit only declined by 4% compared to the previous year, while the average deposit for the commercial banking business, which represents enterprises, fell by 16%. The report points out that the deposit decline is due to companies moving some extra deposits away. Where did they go? most likely to money market funds, in search of higher returns. The remaining funds are sufficient to maintain daily operations. The average deposit in the Asset and Wealth Management Department also decreased by 22%, reflecting that wealthy individuals are also seeking higher returns. Next, let's take a look at the guidance provided by JP Morgan. Banks are special in that we can use their bad debt reserves to gauge their expectations for the future. The more bad debt reserves they have, the more pessimistic they are about the future economy. The financial report shows that bad debt provisions in the first quarter amounted to $2.27 billion, up 58% YoY. At first glance, it seems like a lot, but it is similar to the previous quarter and slightly lower. This is also in line with analysts' expectations. In the fourth quarter of the previous year, due to the strong recession expectations of various enterprises, banks raised their bad debt provisions, resulting in an increase of nearly 50% compared to the third quarter. This once caused panic in the market. However, this financial report shows that the provisions for the first quarter of this year are basically the same as the fourth quarter, indicating that JP Morgan's economic expectations have not changed. Even in the event of a banking crisis, they do not believe that future bad debts will be more severe. This is an optimistic signal. Regarding specific guidance, JP Morgan believes that interest income for the rest of this year will decline. The interest income for the first quarter was $21 billion, which, if annualized, should be around $84 billion. However, they estimate that the annual interest income will only be $81 billion, which is about 4% lower. In the fourth quarter, the company also made a full-year outlook for 2023, which projected interest income of $74 billion. Now, it is $81 billion. This means that so far, JP Morgan's performance has been better than expected at the end of last year, which may indicate that JP Morgan does not believe that the banking crisis will affect their lending. Today, the stock price has also risen 7% due to the financial report. After talking about JP Morgan, I am also quite surprised. I knew that JP Morgan would benefit, but I did not expect such a good financial report performance. However, this reflects the economic situation in the past 3 months. I am a bit skeptical about whether the future economy will be as optimistic as the company, but at least the credit collection situation may not be as severe as imagined, which reduces the pressure of recession. However, at the same time, will it lead to the Fed continuing to aggressively raise interest rates? I personally have some concerns. Let's take a look at Wells Fargo and Citigroup and focus on their guidance for the future to see if there are any differences with JP Morgan. Let's start with Wells Fargo. Wells Fargo's Q1 financial report also beat expectations on both fronts, with revenue and earnings per share beating analyst expectations, mainly due to the impact of high interest rates that allowed the company to earn more interest income. Net profit surged 30% year-over-year to $5 billion. In terms of deposits, the company's overall average deposits declined by 7%, which also reflected customers moving their deposits in pursuit of higher returns. In terms of bad debt reserves, the company had a different view from JP Morgan. Wells Fargo set aside $1.2 billion in Q1, a 26% increase from the previous quarter. Non-performing loans increased by 7% in Q1, or $380 million, mainly due to some problems with commercial real estate loans. During this time, commercial real estate caused market panic, especially office buildings. Due to the rise of remote working, the vacancy rates of many office buildings have been increasing, leading to a depreciation of prices and a decline in cash flow. In the past, BlackRock Group defaulted on its commercial real estate in Finland due to this issue. As a leading bank in the mortgage industry, Wells Fargo also holds a significant amount of commercial real estate loans, totaling approximately $154.7 billion, about 16% of the company's entire loan portfolio. As a result, investors are very concerned about the risk of Wells Fargo's commercial real estate loans. Among all of Wells Fargo's commercial real estate loans, office buildings account for 23% of the portfolio, totaling $35.7 billion. Regionally, California has the highest proportion of office building loans at 29%, followed by New York at 13%. Together, these two regions account for approximately $15 billion in office building debt. As we all know, California and New York are home to many technology companies that are very keen on remote working. The recent wave of layoffs in the technology and finance industries has also had a significant impact on these two regions. Therefore, the risk exposure is enormous. In response to these concerns, Wells Fargo has attempted to reassure investors in its financial reports by stating that 68% of its office building loans are granted to large institutions with high-quality real estate assets, and that it has taken sufficient precautions to manage the risk. The bank has set aside 5.7% of its office building loans as bad debt reserves, and 1/3 of these loans are guaranteed. In addition to commercial real estate, Wells Fargo's allocation of reserves also reflects its confidence in different types of customers. The bank has reduced its reserve for commercial loans by $16 million and increased its reserve for consumer loans by $60 million. This suggests that Wells Fargo has greater confidence in its corporate clients, while consumer confidence is somewhat weaker. It is my belief that Wells Fargo's larger risk exposure lies in its commercial real estate portfolio, which is why it has set aside more bad debt reserves. In fact, this is a prudent move, given that in the future, technology-led companies are likely to continue to lay off employees, resulting in even higher rates of office building vacancies and defaults. It is important to be prepared for this eventuality. However, aside from the reserve allocation mentioned above, the company has not provided much additional information in its guidance. This gives me the impression that Wells Fargo is not particularly worried about the credit risks that may arise from a future economic downturn. Citibank also beat expectations on both fronts this quarter. The company's personal banking revenue for the first quarter increased by 18% year-over-year, and its fixed income business also grew by 4%, which helped the company beat Wall Street's expectations. The CEO's comments on the quarter were also relatively optimistic. When asked about the economic environment by analysts, he stated that the company is in a favorable position to handle any future conditions. They believe that the recent banking crisis will lead to tighter credit and help control inflation. So far, the U.S. is more likely to enter a mild recession in the second half of the year. The CEO also said that they have noticed consumers spending less this quarter, and given the expected weakness in the future, they have not increased their guidance despite the strong performance in the first quarter, instead maintaining their original expectations. On the deposit side, the company's deposits decreased by 3% compared to the previous quarter, but the banking crisis led to a $30 billion inflow of funds in March. In terms of bad debt provisions, the company set aside $1.98 billion, slightly higher than the analysts expected $1.89 billion, an increase of 7% quarter-over-quarter. This suggests that Citibank is somewhat more pessimistic about the economy than JP Morgan. If we look at the financial reports of several banks overall, we can observe 2 points. The first point is that deposits at large banks are also declining. The fundamental reason for this is the interest rate differential between bank deposits and money market funds or short-term government bonds. More and more customers are choosing to move their money to higher return areas. During the banking crisis, large banks benefited as Americans fled from small and medium-sized banks to large banks. Without these deposit inflows, the numbers on deposit outflows would have been even worse. If large banks are struggling, smaller banks face even greater pressure. The second point is that deposit interest rates are rising. Since the Federal Reserve began raising interest rates, large banks in the US have also been increasing deposit interest rates, but the magnitude is far slower than the rate at which the Federal Reserve is raising interest rates. For example, the highest rate at Citibank is only 2.75%, while the Federal Reserve has already raised rates by 5%. This is increasing costs for all banks. Due to the lack of confidence in small and medium-sized banks, people believe that they will have to raise interest rates much higher to attract deposits, further squeezing their profit margins. These 2 points tell us that small and medium-sized banks are facing a difficult situation. As the crisis continues to ferment, if the Federal Reserve continues to maintain high interest rates, the survival environment for small and medium-sized banks will not improve. This is still a cause for concern. Finally, let's have a weekly summary. This week, the three major indexes of stocks all closed higher. The Dow Jones Industrial Average rose by more than 1%, while the S&P 500 and Nasdaq rose by 0.79% and 0.29%, respectively. In terms of sectors, the financial and energy sectors both rose by more than 2%, while the real estate and utilities sectors were the worst performing, both falling by more than 1%. In terms of interest rates, the yield curve of government bonds flattened this week, reflecting weak economic expectations. The yield of 10-year government bonds rose by 2.99% and closed at 3.52%. In the oil market, prices continued to rise, with a gain of 2.77% and a closing price of $82.65 per barrel. The US dollar fell by 51 basis points, with the DXY index closing at 101.56. This week's macro events included two major inflation indexes. The CPI and PPI both saw significant declines. The CPI rose by 5% year-on-year, while the PPI only rose by 2.7%. The Fed minutes reflected the central bank's prediction of a recession in the second half of the year. Weak retail data indicated that consumers are really not spending. In terms of individual stocks, luxury goods giant LVMH reported strong earnings. Tesla established an energy storage factory in Shanghai and discussed building a logistics center with the UK. Apple's Mac deliveries fell sharply by 40%. India's strategic plan achieved initial success. Walmart suddenly closed stores. Samsung announced a reduction in memory chip production. Amazon issued a letter to shareholders, and Bitcoin broke through the $30,000 mark. If you think I did a good job, don't forget to give me a like before leaving. Thank you for your support.